Good evening, and thanks to the SFA again for having me down to talk about tax, and particular PAYE and modernisation and VAT considerations. So, PAYE modernisation, where are we? There's been a lot of coverage recently in the last couple of months with revenue through the media, and just what I decided to do is just give you a very brief overview and some of the challenges then and some issues that all employers should be reviewing now before the 31st of December. So first point then, PAYE modernisation is coming in with effect from the 1st of January 2019. And how it's different is that every month there's going to be a return submitted, and it'll be all based on live data. So therefore, the challenge for employers is that they're going to need accurate, on-time data, and they'll have to get the return right first time. So I suppose if we take a moment, the difference between now in November 2018 is at the moment what you submit to the revenue is just the tax payment. They've no details regarding the gross salary or who's joining or who's leaving the employment. But come next year, come the 1st of January 2019, the revenue are going to receive details of all the employees on a monthly basis. So every month there's going to be a statutory return. So the main differences being, I just highlighted them in this slide, is going forward there's going to be no P35s or P45s or the annual P60 for the employees. Instead, there's going to be, as I say, a monthly, there's going to be a submission made every time you pay your employee. And that's going to detail out the remuneration, the tax, and also the date of the payment. And this submission must be made to the revenue every time you pay your employees. So if you pay your employees 10 times a month, well then you must then make a submission each time. Now, in addition then, what will happen is that at the end of the month, say in February, the revenue will issue a summary statement of all the submissions that have gone in for the month of January. And that will be deemed to be the return for the employer unless the employer makes an amendment to it. So what I was emphasising there is that that statement that's issued by the revenue, that's deemed to be the monthly return. And that is a statutory return going forward. So going forward, you're going to have 12 returns, while at the moment, for 2018, there's only one statutory return, and that's your annual P35. The reason that is very important is because of penalties. There's numerous penalties there for errors of submitting wrong returns or not applying procedures. And those penalties are €4,000 per return. So at the moment, there's only, say, the statutory return, the P35, but going forward, there will be monthly returns. So technically, revenue could charge you $48,000 if they so wished, if there's an error in every month's returns. In addition, you'll probably see in the media that the revenue are asking employers to submit data of their employees before the 31st of October. And the reason the revenue are looking at that is that they have advised that there's some employers have historical employees still on the revenue system. So you may think that you have 10 employees, but in revenue system, they might actually be 20. So the idea is that the employers would would send the list of their employees into the revenue, and then there'd be an alignment of the revenue system and the employer system all before the 1st of January. The reason that's important is that so that each employee can get what's called an RPN before the 1st of January, on which the employer will use to operate the tax, like the old tax credit system. So, where are we now? Like, what should employers be considering to do before the 1st of January, with only 6 or 7 weeks left? And what I'd say is, the first thing, are you ready? Have you looked at your systems and procedures? What is the data flow of the information that your payroll advisor or your payroll department need to run your payroll? And in addition, when was the last time you actually looked at the technical aspects of operating PAYE? So, as I said, like with any organisation, when you're running your payroll, there's different information you need from different sources. For example, the HR department, that'll tell you if there's someone joining or leaving. And the finance department will have details of their current salary and their current BIK, but then their manager may have given them a bonus for Christmas, or they may have decided that the employee needs a company car. So it's the integration and the exchange of information between all of them needs to be given to the person that's doing the payroll. And the reason that's important, that has to be accurate and it has to be on time. So when the person that's running the payroll has all the data before they pay that employee that month. Because remember, the revenue are going to be getting details of all the remuneration for that employee on the date that the employee gets paid. So what I've noticed that in the last 2 years, the revenue are concentrating their revenue reviews specifically on PAYE reviews and VAT audits. So, and these are some of the typical issues that are coming up as part of PAYE reviews. So the first one is benefit in kind and company vehicles or being vans or cars. And there's different operation of how you calculate that benefit in kind if it's a van or if it's a car. So the first way, if we look at, say, the company van. The company van, the benefit in kind is deemed to be 5% of the original market value of the vehicle. But there's also exemptions there. For example, if the employees spend at least 80% of the time out of the office. So what you need to ensure is, if you are claiming this exemption, does your employee actually satisfy the rules for that exemption? And if not, well then 5% BIK should be paid on the van. In addition, another topical issue that has come up is in relation to Jeeps. When you look at a Jeep, you might think that it qualifies for 5% BIK, but a Jeep may be considered to be a car for BIK, and it all depends on the particular circumstances. And this is one area, again, that the revenue review when they're doing a PAYE audit. Now, that can be very significant as to whether a Jeep is classified as a car or a van, because a car attracts a 30% BIK on the original market value. So therefore, if you have a Jeep acquired for €100,000, the BIK could be either 30,000 or it could be only 5,000. In relation then to other points on motor vehicles is that the core benefit in kind charge is 30%. But that 30% can be reduced if there's a certain amount of qualifying kilometres. So again, you should have the system and procedures in place whereby you are ensuring that the amount, the reduction on the BIK that your employee is claiming ties in with the actual amount of kilometres that they're doing on a monthly and on a quarterly basis. Then also in relation to motor vehicles, you need to be careful if the company doesn't own the vehicle, is there expenses going through it that would in relation to a private vehicle of an employee. Motor and travel records. So an employer can repay motor and travel expenses to an employee tax-free. And there's certain limits that you can pay to those in relation to motor and travel records. Now, what's really important here is, to order to pay them tax-free, you have to have sufficient records. There's certain data that needs to be on these records, and if there's not sufficient support, the revenue can treat that as additional income. And you'll see I have a worked example on the next slide as to how costly that can become for the employer if there's not sufficient records. The next point then in relation to directors' loans. It may be a situation that a company director might decide to, might need an additional funds in a particular month, say in January of €10,000, and they have the intention of repaying that 10,000 back in the month of February. In the past, directors may have repaid the funds to the company and thought that there was no issues. But now come the 1st of January, when you withdraw that 10,000 from the company, you must decide, well, what is that? Is it a director's loan, or is it actually a net salary to yourself? Because if it's a director's loan, well, then there's a BIK charge on that director's loan of circa 13%. And therefore, the BIK of that director's loan should be going on your January payroll. So if it's the case that that's not repaid until April, the director has a BIK on that director's loan every month until the loan is repaid. Now, the reason I was asking is as to whether it is a director's loan or whether it's a salary. Because remember what I said at the start, the PAYE has to be returned on the date that you make the payment to the employee, which includes the director. So therefore, if this is really a salary that you're taking and you have no intention of repaying it back to the company, the PAYE on that would be due as part of the payroll run in January. Another area that we see coming up time and time again is when a company engages a contractor, what is the commercial arrangement with that contractor? Would they actually be considered to be an employee, or are they an independent contractor? And there has been consultation papers, there's been further guidance notes, but really it's an area to watch out for as to how frequently you're using a particular individual. Are they an individual? Are they a company? And whether there is potential that that individual could actually be an employee. Now, the reason for that again is that if it is determined that a contractor is an employee, the tax cost on that is going to come back on the employer. And you see again in a worked example I've done in the next slide, and it can become very expensive. Other examples there is taxis. You know, if you have a revenue review, they could ask to see a simple thing like they register for the taxis to see is there any private use, and again, a benefit in kind. In the past, employers, some employers may not have operated emergency tax correctly. So this is a situation where you might not have a tax credit certificate for your employee when you're operating the payroll. Going forward, there's going to be no toleration of that. If you do not have what's now going to be called a PRN, well then you must operate emergency tax. And the non-operation of that has severe penalties. I think the penalty is about €4,000 per offence, per default. In relation to professional subscriptions, there's been a change in revenue practice in relation to this. Previously, it was the case that if you paid professional subscriptions, they were not deemed to be benefit in kind, and you could pay them without any tax implications for the employees. Revenue have changed their position on this in the last 2 years, and where now there's very limited situations whereby you can actually pay professional subscriptions for your staff without them being subject to BIK. So as I mentioned, there has been new legislation brought in from the 1st of January. And what this does is that if a PAYE is not operated correctly by the employer, the tax costs will actually come back on the employer. So you'll see there in the previous slide, I was talking about an employee being paid €1,000 worth of expenses, and there may not have been sufficient motor and travel records in relation to those expenses. So in that case, if the revenue said there was €1,000 worth of expenses and the records were not simply sufficient, what the revenue will do is they will say that the €1,000 under this new legislation is deemed to be the net salary. So therefore then the cost to the employer of paying those expenses is no longer the €1,000. The cost now becomes €2,307, taking into account the PAYE and the employer's PRSI. So suddenly it's very expensive. So that's even excluding interest and penalties on the late payment of that tax. So that similar slide can also be used in relation to the point I was talking about in relation to self-employed versus employees. You remember this point here. So again, if you pay someone that you believe is a contractor, but revenue believe is an employee, the same principle applies, that €1,000 could be regrossed and it'll be on the liability will be that of the company. If your companies have not already taken a PAYE review and a review of their systems and procedures, now is the time to do it, because there's numerous changes coming through in the 1st of January. And what the emphasis is that every time you pay your employee, you're making a submission to the revenue. And then, so if there's any issues currently in place, then those issues must be resolved before the 1st of January, because there will be penalties on the submission of incorrect returns after that. Now, we are currently undertaking these reviews for our own clients, and there's certainly time to do it. But as I was saying, the submission of an incorrect return after January will be €4,000 per return. And also you want to ensure that you have PRNs for all of your staff, and otherwise you'd have to be operating emergency tax procedures. What else are we going to talk about tonight? VAT. So what I decided to do tonight was to break it into two parts. One was in relation to business VAT, and the other then in relation to property VAT. When we look at VAT, again, as part of VAT reviews, these are some of the typical points coming up in the reviews. And one of those, for example, is should you be on the cash receipts basis if your turnover is less than 2 million? And the same goes, like if you're suddenly your business is recovering and you're no longer entitled to be on the cash receipts basis, instead then you should be according your VAT on an invoice basis. Some clients may have multiple companies and you may decide to charge management charge between those companies. And the provision of those management charges attracts VAT at 23%. New legislation was brought in a few years ago called the VAT deductibility adjustment, whereby if you have an invoice and you've reclaimed it as a purchase VAT, well then, and you don't pay that invoice within 6 months, well then you are no longer entitled to the VAT deduction until it's paid. Now there is mitigating circumstances that can review, but typically if you haven't paid the invoice within 6 months, you're no longer entitled to that VAT deduction and you need to adjust it. There is relief there for bad debts. So if you have, if you're on the other side and you have raised an invoice, paid the VAT to the revenue, and your invoice is still not paid, well then there is relief for bad debts that you can also claim the sales VAT back from the revenue. One area that I'd advise all trading companies to be acutely aware of is to ensure that they're filing their visa and their Intrastat and the annual return of trading details. These are all VAT returns and information VAT returns. And sometimes clients might forget to submit the annual return of trading details. And the reason these are important is revenue are actively pursuing them. And if you're not lodging them, it could lead to a revenue audit, but it also will stop you getting a tax clearance certificate, and it would also stop tax refunds issuing to the company. So if, for example, you have a 31st of December VAT return, well then the annual return of trading details will be due to be submitted in January. And it's not just this year. Go back and look and see, are all your annual returns up to date? Because in the past, revenue didn't actively pursue these. So it may be the situation that you owe a few years and revenue will start demanding them and will hold on any refunds. So that what brings me next to next things about group VAT registration. If you have a group and you have individual companies and you're doing cross charges within those companies, you should be charging VAT between them. But however, you can apply to the revenue for a group VAT registration, which allows you effectively to have one group VAT remitter and to have a more efficient VAT administration system. So certainly it's worthwhile looking into if you have a number of group companies. Now, in recent times, there's been a significant change in the way that revenue are now doing their audits, and there's more electronic audits or e-auditing being done. And this database that they have is very significant in that they can run programs through your accounting systems and to pick up any anomalies within them. And one of those, for example, is VAT rates. So in your business, you should ensure that you're always charging the correct VAT rate. For example, if you're a pharmacy or in your supermarket, it'll all be through the EPOS system. So what you should be looking at and seeing is all your products actually coded at the right rate. Because if they're not, this can start to become a very costly VAT liability over a number of years. Other areas I had to say to clients to review is, look at the level of your VAT deductibility. It may be the case that you have 100% VAT deductibility and then at this point wouldn't be applicable to you. But some clients may only have 70% of the trade may be VATable and the other 30% is not. So if that is the case, well then you're not going to be entitled to reclaim 100% of your purchase VAT. And what you'd need to look at seeing is what is the percentage VAT that you can reclaim. So in the next few slides, I just want to outline some points that we see coming up time and time again and in relation to various VAT matters. One of these is regarding the reverse charge VAT on EU transactions. And this is a situation whereby you might be acquiring goods or services from another European country. And you might have an invoice there for 10,000. So you as an Irish business are not physically charged any VAT on getting that invoice. But you might look and see, well, what's actually your VAT cost and what you need to do in your VAT returns. So the first thing is, if you have 100% VAT deductibility, on getting the say you engaged an accountant in the UK, for 10,000. The accountant will not be charging you VAT on that invoice. So instead then, there are specific entries to be included on your VAT returns in Ireland. And you effectively return the VAT, the deemed VAT, and then you also include it as a purchase VAT of the 2,300. So there's no VAT cost to you. But if it's a situation that your business doesn't have 100% VAT deductibility, for example, if it only had 50%, suddenly that VAT will become a cost because you're only entitled to reclaim part of the purchase VAT. Now, one of the points that we see that's causing revenue review is when companies are not recording these VAT entries on the VAT return. There's specific boxes on the bi-monthly VAT returns where you have to put in your EU sales and your EU purchases. And then those figures also then go in on your annual return and trading details. And these are triggering VAT reviews from the revenue because these entries are not included. Now you might say, well, I have 100% VAT deductibility, there's no net VAT cost. But the reason revenue want these done correctly is because there's an exchange of information between Ireland and other EU countries regarding the level of trade. So certainly look again at your finance department and ensure that these are being done correctly. So the next area that I was going to briefly discuss is commercial property VAT. And the areas I was looking at is back now in the recovery, some people might be considering going and buying property. And you might think, oh, is there not just 13.5% when I go and buy a commercial building? And it's not the case. You need to look at the specific VAT history of each individual building, because it may be a case that the VAT liability is actually the residual VAT liability of the vendor. And it may be the case that you don't physically have to pay VAT in closing. It may be the case that there's deemed VAT. So again, if the company or the landlord or the director is looking at buying a property, VAT advice is needed. The next area, say, in relation to leases, and what I'd say is that substantial VAT changes occurred on the 1st of July 2008 in relation to all property transactions. And therefore, if you are looking at either granting a new lease, or if you're a tenant and you're surrendering a lease, or if you're going to sublease, you need to get VAT advice again in relation to each of those. And you'll see why in the next transaction. And then finally, capital good record. This is a document that you're required to maintain and sets out the VAT history of the building. And again, if we have seen in the past, the revenue are now writing to clients who have large property portfolio to see have they kept these records, because it's what they're looking to see, has the property been kept with vatable use and not triggered a VAT cost for non-vatable use. So I just quickly do some examples to just highlight the change in the legislation. So a lease granted for 25 years on the 1st of January 2005 at 100,000. So back then the laws were that you were deemed to have been charged VAT of 253,000 on the 1st of January 2005. And now we're in 2018 and the lease is surrendered. So what happens? So there's VAT implications on the surrender for the landlord. So there's a deemed VAT liability, you run these calculations, and there'll be a deemed VAT liability on the surrender back to the landlord of 88,000. And the property would be deemed to have a VAT life of 7 years. But then when you're looking at this, when the lease has been surrendered back to the landlord needs to get certain information from the tenant. And that would include, has the tenant done works in the building? Because depending on what the tenant has done, it may impact you if you sell it in the future, believe it or not, even if the tenant has done the works. In addition, the tenant may have done fit outs on the works, and those works have a VAT life of 10 years. So the tenant may ask you to take over the remaining VAT life of those works in order for them to avoid a VAT cost. So again, you need to assess the VAT implications in relation to that. And finally, there's VAT return entries to be included on your VAT return. In relation to the grant of a new lease, you'll see back in 2005, VAT was fully accounted for day one on the lease, 253,000 VAT deemed charged, and then there was no VAT on the monthly payments. The big shift now is that when you grant your new lease in January 2019, even on the same property, you would have to charge VAT of 23% on that new lease. And the reason being is that to avoid the VAT cost of the 88,000. So if it's the case that you have a tenant and the tenant has surrendered the lease to you, and you might think, oh, well, I didn't charge VAT in the last lease, I don't have to charge VAT in the new lease. That's not correct, because VAT was always dealt with up front previously, but now you have to charge it on every single rent payment. And the VAT cost, as you can see from that example, can be very significant. So the last example I was just giving, highlighting that if the tenant sublet 30% of the property in July 2008 or July 2018, again, the tenant mightn't think about the VAT and saying, well, look, I have a lease, I'm not paying VAT on my lease. But that's because they were deemed to have been paid the VAT on the first day. So therefore, the tenant actually has to charge VAT on the rental income. And that's in order for them to avoid a partial VAT clawback of the VAT that they were deemed to have paid and reclaimed of 253,000 in January 2005. So from that, you'll see anything to do with VAT and property and leases, you need specific VAT advice in order to avoid all the pitfalls. So, where are we now? PAYE Modernisation is coming fast from the 1st of January 2019. I'd say a lot of employers have a lot done, but I'd say there's a lot yet to do. The one piece of advice I'd give is now is definitely the time to be doing the technical review of your PAYE to ensure that if there's any issues on BIK or professional subscriptions or the detail of the motor and travel records that you have, if there's director's loans, all those issues should be ironed out now in the next few weeks. In addition, the VAT reviews are becoming more and more common. Any particular pay attention to any EU transactions, basic entry returns and the VAT returns to avoid VAT reviews with the revenue. So we will get there, Audrey, at the end of January. There will be sunshine again once we all get through the first couple of weeks of the PAYE Modernisation. And finally, I'd like to say is please feel free to contact me or Audrey Curran. Audrey Curran manages our payroll department in PKF, and she'd be delighted to answer any of the technical day-to-day issues that are arising already on PAYE Modernisation. Thank you very much.
Right, well, good evening. Good evening, everyone. Gosh, I'm not really sure how to follow that session on PAYE. I feel like I'm ready to be running out and starting to, check on a whole bunch of things in our business as well, because it strikes me that there is a huge amount of substantial change coming down the line. Now, what I want to chat about and share some thoughts with all of you on this evening is I suppose about the costs of doing business. And look, you're all in business the same way that I am in business in my firm. And so, I'm not really trying to preach to the converted. I suppose I'm trying to share a few thoughts here in terms of those businesses that we run. Give us some things to think about as well. And I suppose, to collectively think in terms of how do we use organisations like the SFA, how do we use organisations like IBEC to actually help those of us in business. So, right, let's just make sure I know how to use this. Right, okay. So, I suppose, just want to say in advance, look, I am not an economist, and I am sure, in terms of what I'm going to flash up here on the screen, I'm sure that there are way more learned people than me that could poke big holes in this and say that the percentages are not right. And they are probably right. I think at a macro level, what we're going to talk about here is still worthy of debate and consideration. So let's go, let's blast off and see if we can share a few of these thoughts with you. I suppose first off, what I do want to say, and I just need to make sure I'm in line with all the microphones here, is, it's a great privilege and a great honour to be here sharing some of these thoughts with you this evening. Really delighted to be here. So, okay, costs of doing business. Let me go back here again. I'm not great at managing the clicker. Costs of doing business, who takes what? who takes what of your euro earned. So cost of doing business, key element of Ireland Inc.'s relative international competitiveness. Very open economy that we have. What does that mean for all of us here in Ireland? It means, I suppose, that we are particularly vulnerable to price and cost shocks that frankly are outside of our control, on a daily basis. What do I mean by that? I'm talking about shocks that come from outside of our border, higher energy prices, interest rate changes outside of our control, inflation from our trading partners if we are, as say, trading beyond our borders, exchange rate fluctuations. These are all things that we know about, that we understand, that we hear people talking about. So what? What does that mean for day-to-day business? I suppose what it does mean is that we need to do all that we can to manage our own house, to mitigate the effects of those risks that come from beyond our borders. You really don't need any great economic brain, I suppose, to understand that increasing costs in our country reduces the competitiveness of our businesses, the businesses of Ireland, and I suppose also reduces the attractiveness of Ireland as a location for investment. Now, those of us in business, we all know, yep, we can all do our bit in terms of managing our own house, reduce a bit of spending here, eliminate some spending there, driving greater efficiencies in our business. We can all do those things. But what about those bits that we cannot directly control? Those bits that we need government's help on. And there are a number of them, and we'll go through those at a high level. I'm talking about, I suppose, the policies, the procedures, the priorities and the actions of government that are within Ireland Inc.'s control in terms of assisting us managing our cost competitiveness. While we're all doing our bit in the room in terms of our businesses, we absolutely are, I've no doubt about that. We do need the support of government to ensure that the domestic policies that are in place do not contribute and I suppose in fact go counter to all of the work that we collectively are doing on a daily basis to manage our costs. No doubt about it, our country is a very expensive place to do business. It is high cost. I might just move on to that so there's something else to look at. It is high cost and it does appear to be rising. The National Competitiveness Council recently noticed that Irish consumer prices in 2017 are, now wait for this folks, 23.7% above the EU average. You know, it's staggering. You know, we're not talking about kind of 1 or 2%. You know, we're into the 20s here. So what? Again, look, I don't need to tell you all of this. Continuing high rates of consumer price increases can lead to that vicious cycle, right? Increasing price increases that we need to charge, I suppose, that we need to bear in our business as well. Reducing real incomes, wage increases, wage demands, can it lead to decreasing international competitiveness as well? And look, the list goes on and on and on in terms of that. Well, I suppose thinking about all of that, knocking around in my head, what did I think I was going to talk about against that backdrop? What I thought it would be interesting to do at a macro level is to talk about who takes what of your euro earned, or maybe if you look at it another way, what costs do you need to cover, I suppose, in your business to actually earn a return? Again, just to reiterate that I am no economist, so there's no kind of big models that have been applied to this, and I've not tested the theory, and I'm sure the numbers could be tweaked in many different ways, and it may not even apply directly to your business, be it a manufacturing type business or a services type business. But I think the debate is probably one worth having, and us at least thinking about collaboratively. So, okay, let's have a look then in terms of that. So, quick recap again: high cost environment weakens competitiveness in a number of ways. High costs can make us unattractive in terms of inward investment. High costs make firms that rely on domestically sourced products as well can be relatively more expensive if we're selling our products beyond our borders. High costs can also make firms who sell product or services locally relatively more expensive if consumers, the buyer of our services or our product, are able to then source them outside of the country from a relatively cheaper source. So here we go. Let's have a look at this. What I've done in terms of this build slide, again, no huge science or any rocket science involved in this. I've broken down on the side high-level cost categories that we can whip through. They're listed down on the bottom: labour, transport, capital, facility, utility, and then taxes. The second column talks about the actual taxes or the levies that are applied to those costs. And in pretty much in all of the categories, actually, what we'll see is that there are costs, I'm going to call them non-controllable costs, that are actually associated with that. And, following on from Catherine, and I suppose as I've said once or twice, I'm sure the percentages are wrong, because just listening to some of these things about some of the VAT charges and some of the VAT penalties that can apply, and some of the other costs that can be levied on in business, I'd probably be fairly confident that what I've done is understated some of this. Anyway, look, we'll go along, we'll work through this, and as I say, we can have a little bit of a debate about this. That's the percentages there in the second column, and then the final outturn is just multiplying the first column times the second column. So, labour costs, let's chat about that one first. Certainly, in terms of the analysis that I did, some of the research that I had a look at, one of the single highest cost categories that we would have in our business. That can vary up and down, as I say, depending on whether you're a services type business or whether you're a manufacturing type business. So what we've got in here is wages and salaries, pension plan costs. Those are the costs that we as businesses would offer to our employees to ensure our attractiveness as employees in the market. Again, as I say, whether you're services or manufacturing, and the absolute percentage there doesn't matter, but it is a very significant cost for business. I've got here just shy of 60% that I've allocated to labour, salaries, labour costs, salaries, wages, pensions, etc. and the like. Look, in absolute terms, Ireland has the second highest minimum wage in the EU. What we have, the minimum wage here is €1,563 a month. Luxembourg is the highest at €1,998 a month. So there is a big difference between the two of them. But we are the second highest in terms of a national minimum wage on a monthly basis. Now, if we look then over the water to one of our largest trading partners, the UK, and we have a look at their minimum wage, they have the seventh highest minimum wage in the EU at €1,396. So, look, I'm making no comment as I stand here in terms of talking about social issues and very topical things that are prevalent in our country at the moment. But, I suppose the point here is that if that's the minimum national wage, that's what we're stuck with, and we all have to abide by that. What does that mean, though? That means that some of our competitiveness is taken out of our hands because of those key policies decisions of government. As the labour market nears full capacity, we are starting to see skills shortages, no doubt about it. In my own business, it's incredibly difficult to find appropriately qualified people. We're having to look beyond our borders to far-flung places like the Philippines, Sri Lanka, to find those resources. We are starting to see skills shortages, and this in and of itself is starting to create wage inflation, back to the old chestnut of impacting on our competitiveness here. So that's all fine and, I don't know, kind of depressing or very positive depending on how you look at it. But then on top of all of that, so we've now worked very hard to find all these skilled employees, to attract them into our business, entice them in with appealing salaries. And then on top of it, we've got to whack on what I call these non-controllable costs, the employer-related taxes that we have to pay. There's a bit of a blend there. I've allocated 9.5% to that, and there is a bit of a technical makeup of that. When you add on things like PRSI, the different types of costs that you might have to pay over on that. So what I've done is I've done simple averages. I've put a bit of blending on them, and I've come up with of a rate of just under 10% for those taxes that have to then be applied onto that big cost pool that we have. So what does that mean? That then means that our final outturn, simple maths of the two of them, is 6%. So we're having to then pay our salaries and then this additional 6% of costs on top of that. Okay, so kind of going to get the hang of this now. The rest of the other categories that I'm going to whip through are going to be by and large the same. Next one there that I've got is facility costs. So facility costs, either office lease costs or industrial lease costs. Now, when I was preparing for this, there is a wealth of published data that is available out there. If you find that sort of data interesting, that does show that the rental costs that we have here in Ireland for Dublin, Limerick, Cork, and Galway, that it does actually compare rather favourably to many locations in the UK, from the West End in London to Manchester and Cardiff in the UK. Now look, I don't know if that transcribes to anything that you feel or experience in your business, but that's I suppose the beauty of published research, right? So, as I say, that can be good or bad news depending on where you're sitting, that, your costs are favourable with the UK or not, I don't know. But then what we have is the issue of commercial rates, I suppose, to deal with here in Ireland. And again, varying percentages. What I did in terms of looking at council rates and trying to get a handle on those for this presentation is I came up with about a 0.25% to apply to that, 0.26%, 0.25%. To apply to that. So the final outturn is, minuscule. You can't even see the sliver there. But the point is, I suppose, is that there is still a cost that we're having to pay for running our businesses, for operating our businesses. This, I thought, was a very, very interesting point in terms of the revenue collected by local authorities through the commercial rates mechanism. The amount that was collected in 2017 was just short of €1.5 billion of revenue. I think that's a staggering amount. But I thought this was even more staggering, that actually as a proportion of all receipts that the local authorities will collect in commercial rates, the proportion of the rates collected as a percentage of all revenue collected is actually steadily increasing, and has been steadily increasing from 2012 through 2017. I thought that was interesting. Okay, now I think I might have pushed, yeah, okay, here we go. So transport costs, okay. Two aspects here, direct and indirect transport costs. Again, you know, look, you will understand this and you will know this. The price of oil has increased 25% between 2016 and 2017, staggering increase. Things that I spoke about in the beginning in terms of being an open economy come into play here. Production curbs by major oil producers, geopolitical uncertainty around the world, huge factors in the increase of the oil. In Ireland here, closer to home, prices of petrol and diesel increased by around about 6% and around about 8% respectively in 2017 over 2016. January 2018, the cost of a litre of diesel in Ireland was about 4% above the EU average. So, you know, probably okay, I guess. So look, while we are, you know, back to this open economy thought, while we are really stuck with the price of a barrel of oil, you know, around about the $80 mark and rising, what we do have within our own control closer to home is the price, is the taxes and the levies that we then do pay, that we pay on the diesel and petrol. And there really is a very huge spread, I suppose, of those costs between different countries in the EU. So if you want a bit of sickening, light-hearted viewing, pop onto the AA's website and just have a look and see the analysis that they produce on a monthly basis in terms of what goes where on the litre of diesel and petrol. As I say, you know, you can be open-minded about it and say it's very interesting, or it can just make you pretty sick. Their analysis, the AA's analysis in September 2018 shows that 60% of the cost of a litre of diesel is tax, 54% of the cost 60% of the cost of a litre of petrol is taxed, and 54% of the cost of a litre of diesel is taxed. So there you go. So you might be doing all you possibly can in your business, you know, cutting back, not making all those runs, doing less mileage, not trying to travel as much. But the simple fact of the matter is that the maths are just what the maths are, unfortunately, that the majority of your cost and your spend around the diesel and petrol is just taxes that you are paying for the privilege of getting behind the wheel. So so I thought, for, you know, to liven up and make us all feel really good about things, they also show that petrol costs 54 cents per litre in the US and diesel costs 64 cents. So I thought that was rather cheery and rather worthy of note. So in the build analysis here, and I'm sorry the colours are not really showing particularly well. Look, no, I'm definitely in the right place. What I've got there is I've allocated just under 4% in terms of taxes to the costs there, the transport costs. And I said the transport costs were probably about 8% of the costs that we incur on our business. In terms of that tax there, that non-controllable bit, I also worked in a little bit around insurance levies. Consumer prices for insurance show that they are now between 20 and 30% higher than levels in 2014. I'm sure you all know this. I'm sure you feel this on a daily basis in your businesses. Government takes its fair share of that as well. It takes levies on insurance policies, and I'm sure there's way more with things like stamp duty and all the rest of it that get whacked onto these policies. Just short of sort of 4% of taxes and levies applied to that has an impact. It's very small to see, very tiny to see on the side there, but it has an impact of, you know, about 0.4% on the costs that we need to cover in terms of running our business. What have we got next then? Okay, a bit of colour finally. utility costs. I've allocated tiny little sliver there in yellow, about 2% of the costs that we incur in our business to utility costs. Ireland very heavily dependent on imported energy products. Our energy prices are absolutely vulnerable to substantial oil price fluctuations. I've said it quite a few times now. Again, back to research, some of the things that I looked at in preparation for this show that the average electricity prices for non-household consumers, so I guess that's us here in business, show that they've actually declined over the last number of years. It does also show that they are marginally lower than the Eurozone. Again, I don't know if that accords with what you're experiencing on a daily basis, or if it feels that way to you. Taxes and levies that are on our utility costs show Ireland at about 10%. With the EU, wait for it, at about 28%. So, look, it sounds like we're on a good wicket here. And if we look at the UK, it shows that their taxes are about 22%. So, again, relatively, sounds like we're on a bit of a good wicket here in terms of taxes on utility costs. Gas prices do appear to be lower on average than the EU, but they are above the UK. And I suppose, that does have an impact if that is one of our largest trading partners. Again, I thought this was quite an interesting point, is the tariffs charged by local authorities for water and wastewater do vary quite significantly between the different local authorities. So where you're actually located in terms of where you're doing business does appear to actually have an impact and does appear to matter in terms of that. So look, I've just very unscientifically allocated an amount of about 0.3% to our utility costs, and again then the final outturn is that minuscule little sliver, which when you look at it like this, you're thinking, oh, it's not very big, but all of these percentage costs do add up. 0.5% here, 0.25% there. My second to last category is, got them in the right order, is capital costs. Cost of credit in Ireland is impacted greatly by our concentrated lending market. Anybody looking for funding for their business will know this and understand this. You will all, I suppose, as well appreciate the high credit risk premiums that are being demanded by the lending market here in Ireland. Interestingly, the annual European Investment Bank survey shows that while bank loans do remain as a main source of funding for business, they actually showed that this did drop. Did drop in 2017. It did show that leasing, interestingly enough, seems to be becoming a more prominent form of financing in businesses, with things like bonds and equity grants, those type of things accounting for less than 10% of all external financing used. So I suppose really kind of concluding remark on this is that the cost of credit does remain extremely high here in Ireland compared to the EU average. Here I've said about 14% of costs are allocated to capital costs. Then, in terms of what's paid over to government and the slice that government takes, it is very difficult to estimate. But I guess with things like the bank levy that's being paid, I'm guessing that's inevitably being passed on to us as the consumer. Other taxes, for example, like dirt. What I've said is let's allocate about 2% as taxes and levies to those capital costs, leaving you with a very small sliver there. Again, just short of under 0.5% at about 0.4% is the final outturn on that. So, okay, here we go. Bit more colour again. Taxes. Now, I suppose this is I suppose a very positive part of our story here in Ireland Inc. There's a huge amount made of this in terms of our tax rate. It's one of the lowest ones going out there. There's a huge amount of fanfare about it. I see it on a daily basis in terms of the clients that I'm dealing with. A lot of multinationals coming in. This is one of the things they want to talk about. They want certainty in this tax rate. It is a very big selling point for Ireland Inc. So while the final outturn, there is way more green than anything else, I guess, that's because that's the full-on impact of that is that you're going to pay off 12%, 12.5%, give or take deductions, etc., on your final outturn. So, you can look at that as a cost to your business, or I guess you could look at that and say, well, I've earned enough money. I'm lucky to be able to pay taxes. Don't know. Depends on your perspective, on all of these things. So look, what does all of this mean? I suppose very rough. I acknowledge that. Very crude analysis here. We are a high cost economy here in Ireland. But I don't think there's any debate, certainly in my mind anyway, that a part of those high costs are driven by the taxes and the levies that we do have to pay, here in Ireland on the costs that we incur to run our business. There is a lot that we can do to control our costs in our business, but there is a bit of a double whammy here in terms of it being a very open economy, so we are susceptible to shocks from outside of our borders, things that we can't control. But we also have these taxes and levies, which do consume, in my view anyway, a large portion of our expenditure, and they're not controllable. We have to pay them. Look, I suppose the other point to make as well is that all countries have to pay taxes and all countries have to pay levies on businesses, and I suppose we're no different to that here in Ireland. So I suppose look, depends where you stand on this. I suppose the final remark that I do want to make, just in summary of all of this, is that they do have an impact on our competitiveness, where we rank on the competitiveness scale. I suppose in the international economy, they are points for discussion and consideration. And I think what I would encourage everybody to do is that given the opportunity to talk about them, is that we should, I suppose, get into dialogue with local and national government representatives. We should use the resources of organisations like the small firms, like IBEC, any other bodies that you might belong to, those very strong lobbying bodies that have a very powerful voice to be heard. I think it's very important that we are connecting in and using those organisations to work on our behalf as business owners and drivers of business in Ireland. So that is probably really all I wanted to say in terms of costs. That there is a portion of our costs that really are out of our control, and I think if we have the ability to enter into that conversation, I think we should take that and jump in there and grasp that with both hands. So that's probably all I wanted to say. Thank you very much for the opportunity, I suppose, to share those few thoughts with you for what they are worth. Great opportunity to be here, and thanks very much. Thank you.